Real estate stocks are having a real tough time this year. The sector has lagged behind the broader market, down nearly 7% in 2024 amid a broader market rally. But one key conviction could spark a major upside in the months to come. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. And joining us to discuss, Haendel Juste, Senior Equity Research Analyst at Mizuho, covering REITs, alongside Gregory Kuhl, Global Real Estate Portfolio Manager at Janus, Henderson Investors. Welcome to you both. And Greg, maybe I'll start with you. Listen, we talk REITs, obviously a lot of very interesting verticals, Greg, to get into there, but maybe start big picture, 30,000-foot view. Greg, how are you thinking about REITs in general? Are you broadly bullish here, Greg?
Hi, thanks for having me. I would say yes with the right time frame. So I think what's really important to remember about REITs is, this is an interest rate sensitive asset class. And as we talk about listed REITs, we reprice every day in the market versus maybe private real estate that doesn't, right? So the good news there is that as we've seen a huge shift in Fed policy in underlying interest rates over the last couple of years, we've seen listed REITs reprice downwards to reflect that. And you kind of referenced that in your opening comments. As we look forward, I think we're pretty optimistic that assuming we are done in terms of Fed rate hikes and higher rates, listed REITs today are priced for the interest rate environment that we have, which means they can do well. And just to give you a sense, since the beginning of 2021, our sector is down roughly 20% on a total return basis. At the same time, REIT cash flow per share has grown in the mid-teens cumulative on that time period. So it's not an issue of fundamentals, it's purely an issue of valuation, which we think we're getting towards the end of.
Haendel, I would ask your opinion on the sort of relationship between rates and these stocks as well, because even if the Fed is done hiking, if rates are going to continue to sort of hover at these levels for a while, is that going to be problematic for the sector?
Yeah, absolutely. I think that there certainly has been a concern that with rates appearing to be set, higher for longer, we came into this year with expectation of 5 or 6 rate cuts. Now we're down to maybe basically 0. But if we have rates that are higher for longer with stickier inflation and a slowing growth backdrop, there have been some concerns raised that that isn't ideal for real estate. So certainly that's something that's on investors' minds. And we would point people to sectors where there's clear demand tailwinds, apartments, healthcare, data centers, and stocks are names with pricing power, better than average earnings growth to alleviate some of those concerns.
And Greg, I want to bring you back here and actually go right there. When you kind of lift the hood here, Greg, what parts of the market do you find attractive here right now? Is it housing, healthcare, data center, office?
I think all of those are attractive on a long-term basis, maybe with the potential exception of office, but even office at the right price can be interesting. And you've seen actually office stocks do really well. I think to highlight a few that we really like at the moment, I would say some of the more specialty property types, something like self-storage REITs, where, we think that we're in the process of a bottoming out there on a fundamental basis. And that's a really good long-term business that we like with really low CapEx. Haendel mentioned healthcare. We also like that quite a bit. The demographic story of kind of the 80 years and over demographic paints a really positive picture for demand for healthcare REITs. At the same time, supply of assisted living and senior housing is almost as low as it's been in a decade. So that's really good. And then the third area I highlight is maybe more of a specialty situation. At the right price, even something like malls can be interesting. So one stock that we like in particular is Macerich, which trades at a very large discount to its only public peer in Simon. There's a new management team at that company. Malls is a business that we don't think is particularly great long-term, but we also think it's not terrible if you own the best malls. And so that's a specific situation where the public markets are giving you something at a really good price in our view.
And maybe something else that is counterintuitive to a broader narrative is multifamily. And Haendel, there you like a couple of stocks in that subsector. Why multifamily? And for the lay people, multifamily is what we like to call apartment buildings, where you have a lot of families living. Why is that a good area to look right now?
Sure, sure. So yeah, we've all lived in apartments at some point or another in our lives, but it's a subsector that's underperformed the last couple of years as, the earnings growth, the fundamentals were slowing. We're getting to the near the end of that, actually. We've seen inflection in the road ahead. There have been pockets of, oversupply in certain regions, the Sun Belt in particular, Seattle, certain markets around the country. So that concern is still out there, but there's been really strong job growth this year. So the absorption of those excess units has been a bit better than feared. And so we think that with getting past the peak supply, and we're about to pass that either second or third quarter, depending on which market you're looking at, plus the inflection with better rents and then eventually earnings growth in the road ahead, and thinking about where the stocks are trading today at meaningful discounts to their long-term averages, to the private market values. And that's, by the way, is on trough revenue and trough earnings, that the sector could be at the beginning of a multi-year recovery. And stepping back, thinking about the alternatives in the marketplace, there is generally a shortage of housing in this country. Demographics certainly support an immigration demand for housing, but thinking about the affordability of single-family housing with the mortgage rates near 7%. So that's an additional tailwind of support for the rentership side of the business.
Greg, bringing you back in here, I'm interested internationally. Any opportunities, Greg? Any spots, China, Europe, or no, you'd rather stay here in the U.S.?
Yeah, I think there's plenty of opportunity internationally in a couple of areas. China is one that we've probably shied away from a little bit more in recent years, but the opportunities are a little bit different in Europe and Asia. So I think in Europe, you have stocks that trade at really interesting valuations. You maybe have less of the quality compounding growth stories there, although they do exist. To us, that's a valuation story, and that's pretty interesting at the moment. And then Asia is somewhat similar. It's a bit in between the U.S. and Europe in terms of a mix of valuation and also really high quality kind of growth within REITs. The biggest thing, though, maybe to think about in those markets is just the overall maturity of the listed REIT space in the U.S. versus ex-U.S. REITs have been around a lot longer in the U.S. It's a lot more mature business than it has been outside the U.S. And if you think back to sort of the 90s and the earlier part of the 2000s, owning the stocks through that maturation process to where we are today in the U.S. has been a really good experience for investors. We think the same thing can be said for ex-U.S. In the decades ahead.
Greg, Haendel, thank you guys both so much for joining the show today. That was a great chat. Appreciate it.
Thanks for having us.
Thank you.